Good morning. Underwriting a commercial deal like a pro. So, underwriting is where commercial real estate deals are truly won or quietly lost. And the purchase price might get the attention, but the professional investors and lenders focus on the cash flow, the risk, and the durability. And if you want to underwrite commercial real estate like a pro, you must think the way lenders, equity partners, and institutional buyers do. This guide walks through the real world underwriting framework used by experienced investors and commercial lenders. So let's start with step one. Start with asking the right questions, not necessarily about price, but about income. And professional underwriting always begins with net operating income, or NOI, and not the broker's pro forma statements. So some key income checks to look at. Look at the in-place rents versus the market rents. Look at the lease terms and the expiration risk, but also look at the tenant credit quality and also the vacancy and credit loss assumptions. And the point is that overestimating income is the fastest way to overpay for a deal. Step number two, normalize the expenses like a lender would. So many deals look good on paper because their expenses are understated. And professionals can normalize this by looking at property taxes and verifying, if it matches the current assessment, but also insurance, especially in Texas, the rising cost of insurance is a real thing. But also make sure your repairs and maintenance budgets are actually sufficient. And if there's management fees, even if it's self-managed, but also look about putting money towards reserves for capital expenditures. So if expenses look too clean and too small, they probably are, is the point. Step number three, stress test the NOI. So smart underwriting assumes things will go wrong. And that's not necessarily a pessimistic thing, but a realistic thing. So run scenarios for higher vacancies and slower lease ups, but also expense inflation and potentially rent stagnation if you can't get the rents to increase. But also look at your tenant rollover risk. And if the deal only works in a perfect scenario, it's not a professional deal. Step number four is understand the debt before you lock the deal in. And financing is not an afterthought, it's a part of your actual underwriting process. So here's some key lender metrics to include and to be careful and mindful of. But number one is the DSCR, or debt service coverage ratio, but also the debt yield, or the loan to value, or LTV ratio. But look at interest rate sensitivity as well to model things out. But many commercial deals will fail because underwriters or buyers don't underwrite with realistic debt terms and use hypothetical terms. So, step number five, analyze cash flow, not just cap rate. And cap rate is the starting point, not the answers. So, professionals will focus on the cash on cash return, the break even occupancy, but also potential refinance risk and exit cap rate sensitivity. And a lower cap deal with strong financing can outperform a higher cap deal with a weak structure. So, step number six, know your exit before you buy. And every professional underwrite includes an exit strategy. So, some questions to think about. Who's the buyer at the sale going to be? And what cap rate will they require? And also, what condition will the asset be in when it's time to sell? And another question is the value creation realistic based off of what you can see at this point? And hope is not an exit strategy, is the point here. So, step number seven is align the deal with the right capital stack. And great deals fail when capital is mismatched. So, professional underwriting considers the equity expectations you'll need to meet, but also the preferred returns you need to pay for the equity capital, but also looking at refinance windows and also monitoring your hold period and understanding what your target structure is going to be. And the right structure can turn an average deal into a strong one. So here's the final thought, and that is underwriting is a skill, not a spreadsheet. Software helps, but judgment wins deals. So the best investors will combine some conservative assumptions as well as lender first thinking, but also knowing your market and awareness of where things are going. And you need to be disciplined on price. So if you want to underwrite commercial deals like a pro, think like the person funding the deal, not the person selling it to you. So if you want a second set of eyes on any deal or want help aligning your financing with your acquisition strategy, the Viking Enterprise Team at eXp Commercial is built exactly for just that conversation. Please visit my website, HoustonRealEstateBrokerage.com, and you can get a hold of me. We can talk about your scenario. Have a good day.